Let's dive into the Moving Average Convergence Divergence, otherwise known as the MACD.
At its most basic, the MACD indicator tracks the difference between a fast-moving average and a slow-moving average. Investors can adjust the duration of these moving averages, but many commonly use the 12-day as a fast-moving average and the 26-day as a slow-moving average. In other words, the MACD subtracts the 26-day moving average from the 12-day moving average. Investors can use this information to help define trends, or they can take it a step further and use the indicator when applying the signal line. The signal line is a faster moving average that crosses above or below the MACD. Typically, a 9-day moving average is used as a signal line. Investors may use the signal line to help identify crossovers, which then helps them pinpoint potential buy and sell signals. A crossover occurs when the MACD crosses above or below the signal line. A bullish crossover occurs when the MACD crosses above the signal line. Some investors may consider this a buy signal. On the flip side, a bearish crossover occurs when the MACD crosses below the signal line. Some investors may consider this a sell signal. In addition to the signal line, the MACD indicator has a histogram, which investors can also use to identify crossovers. The histogram plots the signal line from a different perspective. For example, if the signal line is trending down, the histogram plots a negative value. But as soon as the signal line turns higher, the histogram displays a crossover and plots a positive value. So when the histogram goes from negative to positive, it coincides with the MACD crossing above the signal line.
So to recap, the MACD can be used to measure a stock's momentum and determine its trend. The MACD indicator tracks the difference between a fast and slow moving average. Now, investors can adjust the duration of these moving averages as well. A MACD histogram can be used to potentially identify trading signals.